Is cash income legal in New Zealand? What are the 6 big mistakes you can make when dealing with cash? And how can you avoid them? In this video, I'll give you the answers to these questions. Let's dive in and learn how to stay out of jail. Cash income is legal in New Zealand because cash is legal tender. You're entitled to pay for anything in cash, and it's okay to do jobs for cash. But there's a fine line between what is completely legal at one end of the spectrum versus committing tax crime at the other extreme end. There are definitely some good use cases for using cash, which I'll talk about more at the end of this video. So if there are two extreme ends of the spectrum when dealing with cash, there are bound to be mistakes. Keeping this in mind, let's explore 6 big mistakes and how you can avoid them. Mistake 1, failing to report and declare cash income. One of the biggest mistakes you can make is not reporting cash income. While receiving cash income is not illegal, failing to report it to the IRD is and constitutes tax evasion. Under the Income Tax Act, all income, whether received in cash or through other means, must be declared for tax purposes. Failure to report cash income can lead to significant penalties, including fines and potential criminal charges. You can go to jail for tax crimes. Here are some recent examples of this from 2024. In the words of IRD itself, every undeclared cash job leaves a trail. Declare it all or risk everything. For an experienced investigator, it's very easy to trace undeclared cash jobs. In fact, here's the funny thing. Sometimes they may even let you do it to gather stronger evidence. Look, it's much easier doing things right the first time than trying to fix things later. I've spent the majority of my career doing financial audits, worked with the Big Four and mid-tier public practices, and even worked as a frontline regulator on audit quality. So trust me when I say this, do the right thing because it's not worth it. The second big mistake is poor record keeping. Even if you declare cash income, you need to keep good records. Taxpayers are required to maintain sufficient records to prove their income and expenses. Records must be kept for 7 years after the end of the tax year to which they relate. This period can sometimes be longer, especially if you are under audit or investigation. The 7-year rule is codified in legislation and is a must-do, not just a recommendation. There are a few misconceptions in understanding the 7-year rule. The 7-year rule is on a rolling basis, so please don't discard all past records in your 8th year of business. Bank statements alone are not sufficient to meet record-keeping requirements. Records must be kept in English or Te Reo Maori. They can be in paper or electronic form, but must provide a complete audit trail. Failure to keep proper records can lead to costing you big money, such as not being able to claim expenses if you do not have adequate documentation, or reduced insurance payouts if you cannot substantiate claims, or penalties for non-compliance during an IRD audit. So what's the solution? You don't even have to spend any money for this. I'll put the links in the video description where you can download a free cash book template and also free record keeping checklist for you to work through. This will help you keep detailed records of all cash transactions. If you want to step up your game, then use digital tools and software for easier and more efficient record keeping. Personally, my suggestion is to consider using a cloud accounting system like Xero to meet your record keeping requirements. A common mistake is not setting aside enough cash to cover tax obligations, leading to difficulties in meeting tax payments. To avoid this, implement a system for regularly setting aside cash specifically for taxes. One effective strategy is to set up automatic transfers to a separate tax savings account. This ensures you have funds available when tax payments are due. Additionally, regularly review your cash flow to monitor your income and expenses. This helps ensure you consistently set aside enough cash. Consulting with a tax professional or an accountant can also provide valuable guidance on estimating your tax obligations and advising on how much to set aside. The fourth big mistake is not fully understanding the risks of using cash. Using cash comes with several risks, the obvious ones being risk of theft and risk of fake notes. Additionally, the IRD has been focusing on industries like construction, tradies, and property for cash transactions. Guess what? Last year, nearly 7,000 anonymous tip-offs about cash jobs were received by the IRD, with construction being the most reported industry. And the IRD is now taking a firmer approach to ensure compliance. Banks may question about proof of funds for large cash deposits, leading to increased scrutiny and waste of your time and energy in answering questions. Using cash can also complicate financial reporting and make it harder to track business performance. Also, did you know that businesses can legally refuse to accept cash as a form of payment? There is no legal requirement for businesses to accept cash as long as they let customers know beforehand. The only exception is if you want to pay off a debt. If you want to use cash to pay off a debt, they are obliged to accept it. So what's the solution? Consider using electronic payment methods. This reduces the risk of fake notes and theft and provides a clear record of transactions. I understand that for some this may require a mindset shift. In the first year of when I moved to New Zealand, I normally used to pay in cash, simply because it was the most convenient option for me. Paying in cash was in fact pretty common and the norm for the 30 odd years that I lived in the UAE. The takeaway here is to please do your own research and understand the risks associated with your particular industry that you operate in. Mistake 5, ignoring the red flags. Do not ignore red flags. A business that always insists on paying in cash can sometimes be a red flag to avoid declaring income and can possibly also get you in trouble, even if you're not the one receiving the payment. Say you have a rental property and get some repairs done by a tradie. You pay cash because it's cheaper and you don't ask for an invoice. Not only might you not be able to claim this expense because you have no records for the transaction, this might also raise an issue of whether warranties are valid in such a scenario. God forbid there is a leak or a fire leading to an insurance claim. You might not be able to substantiate the claim and hence lose the payout. If you ask for an invoice, this makes it harder for the person you're paying to hide their income. There are avenues to report suspicious activity to the IRD if you suspect that a business is not declaring their cash income. But please, don't be holier than thou. Exercise extreme caution and do not jump to conclusions. Avoid making accusations of tax evasion solely based on the use of cash without solid evidence. In New Zealand, the concept of rewarding whistleblowers for reporting tax evasion does not exist. Compare that to the US IRS whistleblower program, which offers financial rewards in the range of 15% to 30% of the proceeds collected. Now that's motivating. Maybe there isn't enough incentive out there. Mistake 6 is not asking for help. This is quite important. Seeking help is a sign of strength, not weakness. And you don't have to spend money to seek help. The IRD offers various support services, including online resources and helplines. If you've made a mistake or filed an incorrect tax return, let the IRD know proactively. Voluntary disclosure can help reduce penalties and maintain your good business relationship. By making a voluntary disclosure, you may have penalties reduced by 100%. Explore options such as installment plans. If you're struggling to pay your tax bill, the IRD offers installment plans to pay this off. Attend or listen to IRD seminars. These provide valuable information on various tax topics, and these are also recorded for convenience if you cannot attend in person. Request an IRD business advisory visit. They can provide tailored advice to help you manage your tax obligations. If you're not comfortable with any of these options, then talk to an accountant or a tax agent. When you proactively try to address issues, it's only natural that the IRD will try to help as well. If the reason you prefer cash income is to save on taxes, then let me tell you there are much better and legal ways to do this. You can watch my other videos on how to pay zero tax or the expenses you can claim against your taxable income. Personally, I think it's a good idea to have at least some cash on hand in case you can't use your card or need it in an emergency. I've had my fair share of instances when cash has come in handy. When uncertainty strikes, such as natural disasters or a pandemic, many people will turn to cash. This is backed up by the Reserve Bank data. In March 2020, when the lockdown hit, people rushed to withdraw cash. About $800 million were issued from the Reserve Bank, which was more than 5 times the amount of cash compared to the year before. Also, I don't think that cash is necessarily a major vector for disease. Ironically, research shows that the most dangerous items in a supermarket are things like pin pads on card machines, touchscreen self-checkout terminals, and trolley handles, and not cash. I hope you found this video helpful. Thank you and see you next time.